morning, good afternoon, good evening, yWhales, wherever you are in the world. It's our one challenge. Again, I continue to complain about it. Like we can move money around the globe 1,000 times in a minute. Can't control time zones, so it kind of happens. That being said, 2022 has really been off to kind of a very interesting start. So here it is, June 1st. I will say the market, started off very strong at a few points. And quite simply after the Terra UST debacle, we've seen a real cooling off period. And I think that again, where we can talk about that's both of a massive hit to the industry. It also becomes a little bit of the strength that happens because the true developers, the true teams have now a little bit of time and a little less focus on them to pull back and really build their foundations. That's what happens in these down markets. That's what happens in almost any recession, not saying we're in a recession, but any time where the stock market isn't as hot and people start focusing on the technology. And so I've got Jamie Burke here today from Outliers and really want to kind of, dive into a little bit of the history of how Outliers was formed and really where it is today and how it's helping to drive the industry from a massive perspective as well. So Jamie, thank you so much.
Hey there, thanks for having me on. So Outliers over 8 years old now. Today we are the world's leading accelerator in Web3 by volume, hopefully quality. So we've got a portfolio of about 135 startups at the moment. We're going to add another 200 over the course of 2022. So wow. That kind of scales indicative of where we are as an industry, but then also hopefully us as an organization, our ability to execute. And there's still a huge number of brilliant founders building in a space, entering a space. And there's still a lot of capital there as well, but I guess we'll come to that a little bit later. How we got to where we are is, being over 8 years in the space, there wasn't really much of an industry at that time. I think we were certainly in kind of the first 3-4 funds technically that were investing in the space. We were founded not long after Blockchain Capital. Over on the West Coast. But the difference was we didn't have any money. So a lot of the other funds were actual funds in that, they had LP money to invest, albeit not much compared to today's funds. Yeah. But we didn't have any. We had some of my personal savings. I'd done a couple of other startups prior. So I put a little bit aside, didn't really know where it was going at the time, but couldn't think about doing anything else, kind of divested my time and money out of pretty much everything that I was doing that was non-crypto and just said, well, look, it feels like this is worth investing time in and something good will come out of it at the end. The aspiration being at that point a fund. But, the reality was I was sat here in the UK and didn't have a track record as a fund manager, didn't have a huge amount of capital myself. So we just set about initially creating a studio. I found a technical co-founder, a guy called Aaron van Ammers out in Amsterdam. He was basically the only developer I could find at crypto meetups that I understood what the hell he was talking about. Like, felt like an actual human.
Still maybe the only one that exists.
Yeah, that's right. And had some commercial expertise and experience. I thought, great, okay, I can, we speak kind of the same language here. And so we set up a studio to just get some applied learning. And so of course that was pre Ethereum and then, very nascent Ethereum. And we were playing with technology and breaking it and very quickly realizing that, all these use cases that everyone was very quickly talking about that would be possible as a consequence of blockchain were many years away, maybe even a decade away. And there was a lot of infrastructure that had to be built, a lot of technical problems that had to be solved. And so at that point, we decided to kind of focus on becoming an incubator. And again, keeping in mind that we had no money to give people would come to us thinking we'd give them investment. We're like, well, yeah, we don't quite have any money, but we can help you do this, we can help you do that. And we've got this applied learning, so we can help fast track, your development curve. And we would basically earn a place on the cap table. And But being an incubator and focusing on infrastructure, so we moved away entirely from applications. We stopped working on them, partnering with them, and only work with infrastructure. And the challenge with that is that it's deep tech, so it's multi-year R&D. It's very technical, so you need a lot of expensive specialists on hand. And because projects are coming in and out of the incubator at different times, you didn't have cohorts, then they all needed different things at different times. So you ended up with like really poor utilization of very expensive people. That said, we still managed to make a really good profit from doing it, from our time. And we took those gains and reinvested all of them back into the platform, hiring more people, developing more competencies, and trying to build up a little bit of a cash buffer. And really that was done through finding angels, family offices that were curious. We set up something called Blockchain Angels, which was primarily in Europe at the time, although we did do events in like Boston and Chicago, which was introducing curious early stage tech angels to the possibilities of blockchain. And we'd try and find some startups that were half decent and bring them along.
What year was that?
Oh God, I can't do years. I mean, this would have been 6 years ago. Yeah, probably 6 years ago.
So pre big crash.
Yes. Oh yeah.
Okay.
Yeah. Right. We kind of hit the curve going right into 17.
Okay.
Which was a great time for us in validation in a way. All of a sudden there was this huge interest. It was pre R3 coming online and bringing all the banking consortia. It was pre digital assets holding. All of a sudden you had like Blythe Masters and people in the traditional financial world saying, yes, blockchain was a thing. Of course, the narrative at that time was blockchain, not Bitcoin or not crypto. But we do these meetups and, at the end of it, like 20, 30 people showed up and maybe one had come up to me at the end and say, hey, this is interesting. It sounds complicated. I'd love to learn, get some exposure. Can I give you 25 grand, maybe 15 grand, 25 grand? And I'm like, well, hey, that buys us another couple of months, or I'll take it. And we were really like hand to mouth for years, like
Wow.
just trying to lock in another couple of months. I'd gone all in personally, but it felt like this thing would be a thing. The industry was growing. And so we kind of grew this partnership model of just taking in individuals. It's only just this year, 2022, that we've actually taken in institutional money, partners for the first time, sovereign wealth fund, and a large publicly listed tech company. We haven't announced the details of that yet, but in material money.
Congrats.
Yeah, thanks. And but for a long time, it was just, we got to find a new partner. It's somebody else to come in and they'd start co-investing a little bit. And we
so let me pause you real quick, because the story keeps going and I keep missing points I want to talk about, because there's so much history here, and anyone that's listening really needs to recognize that almost every fund that exists today, crypto fund or blockchain fund, whatever you want to call it, really sits on Outlier's shoulders. I mean, what you're hearing Jamie talk about is the asset class was at best, even way back when, was still kind of a Silk Road-ish. That's what crypto was thought. I mean, so you coming in and saying like, hey, we believe there's some real technology here, when 90% of the use case for Bitcoin was illegal substances, is a huge amount of foresight. So and again, you were able to find like a technical founder to help with, and it hasn't grown a ton yet over these years. So really, where we sit today, what was kind of in those early years, that 18 crash that we're talking about, what was the overall sentiment even of the startups that existed back then? I mean, were they even convinced about where this was going, or were they just like, hey, we can make cool coins?
So it's funny because just yesterday, I'm embarrassed to say I still use it. I kind of check in occasionally on Facebook, make sure the old people are still alive, you know. And so I kind of checked in, and it does this time machine thing. It says 4 years ago, you posted this post or this image, and it was an image of some charts that we did. So we created a database of every blockchain startup we were aware of, and I forget the numbers now. In total, that database got to about 2,300, 400. And this was like probably all the way up into 17. But I think when we first did the chart in 16, there were only 250 blockchain startups globally.
Wow.
And, in fairness, we looked at the categories of them. I had this pie chart. We categorized them all. And it was pretty diverse spectrum of use case. Gaming was already in there, but this was kind of pre-NFTs.
Yep.
At least pre-NFTs as we now know them on the Ethereum network. People were playing around with colored coins a little bit, beyond just fungible assets. And of course, Ethereum was pitching itself as the world's supercomputer. That was its pitch back then. And there were actually a lot of industrial use cases. They were talking about IoT.
Yep.
Weren't really talking about DeFi and stuff back then. So, there was, it very quickly caught on. There was a lot of people that once they understood the basics of digital scarcity, the ledger component, people who had exposure to primarily financial capital markets, but then also other industries could conceptually connect the dots. They then create a startup, try and use the technology, and it just couldn't deliver on what they needed to do. You could argue now still many use cases just aren't possible on Ethereum. The scalability, the affordability, what have you. So
usability, reliability.
Right, but they were all there. They were knocking on the doors. The use cases, many of the use cases. I haven't seen many new use cases, new applications conceptually. We're already thinking of them even back then. It's just now you've got this composable stack, this Web3 stack to execute them on. So, what was it that convinced me? I don't know. Like prior to that and prior to doing startups, I'd spent my early 20s riding the Web2 wave, initially within communications, WPP group, and then eventually setting up agencies and consulting arms, my own consulting business in the end. What we called in the Web2 movement, it was looking at peer-to-peer technologies for obviously marketing and communication, what that meant to the communications industry, but then also for market research and various other things. So I'd had one of the great things about working in advertising and or consulting is you get exposure to lots of industries, in a very condensed period of time. You have to kind of get your head around the basics of that market. So I probably had like an unusual level of exposure to different industries in my 20s. And then, when I came across Bitcoin, I think went to the first Bitcoin conference in Europe, which was in London. And I couldn't stop thinking about it after that, like the innovation of digital scarcity and having provenance, like something that could be digital and scarce and therefore hold value, and you could have the provenance of that thing. It immediately clicked that is applicable as a generalized technology outside of Bitcoin to a million different use cases. And that represented a different paradigm shift. I wouldn't say I had a sophisticated understanding of that, but it was more of an intuitive one.
But even back then, when you were in the like you chose to go start Outliers in a brand new and emerging asset class with tons of uncertainties, like you felt this is the future and it's most likely right around the corner. And here you are 8 years later. Tell me kind of, because I see people every week and it's like their first month exposed to Web3 and they're like, oh my God, this is the future. And there's the FOMO to just dump everything they have in because they're just like, I feel like I've been left behind. And then we have someone like yourself that comes on here and you're like, nah, I've been here for a while. it's moving, but it ain't. It's not quite at that level. But tell me, the feeling then of you going all in, which is very early, and then kind of how you maintain the composure to stick with an industry that can rise and fall by 90% on any given day.
Yeah, well, look, I mean, I'll be honest with you. It was probably a lot to do with my personal circumstance at that point. I remember the time period when I chose to go all in, because I didn't have very many other options. I mean, I could go back and do consulting, and I hated it. I built this consulting business, and it kind of worked. I had 100 people, but I just, consulting businesses are a pain in the ass. Very difficult to scale, very difficult to value, very difficult to raise money into.
Yep.
And so I was a bit kind of jaded from that. I think my father passed away, and my partner at that point had left me. It's like, with my 1-year-old child. So it's like I remember it was a really brutal year. And this Web3 thing was going on. Like, well, this Bitcoin thing was just ringing in my head. And, personal moments like that compel you to like violent action, right? Or radical action in a way. And so I felt like doing something radical. And at that point, this was the most radical thing I could, I could experience, other than just going and doing digital innovation and change management for like, some boring corporation. So, so as I said, I had a little bit of money, and I thought, well, this is worth a punt. And, fortunately, the feedback loop wasn't as long as I thought it might have been. Like at that point, I thought, wow, this is going to be many years before anybody's like remotely interested. It was very niche. It was very nerdy. It was very, very politically oriented with a kind of libertarian mindset. It was not for everybody. Yeah. And I think I remember for a long time, and I wish I'd done more thought leadership more early, because we became quite well known for it in the end. I had huge imposter syndrome because there were some very, very bright technical people, not just coders, but, like mathematicians, and it was hardcore. And so, trying to speak about blockchain with authority in that environment was very, very intimidating. But what I realized is that those people, as intimidating as they were, very few of them had any commercial experience. And as intimidating as it was for me, it was even more intimidating for everybody else that wanted to engage with it. And so I realized there is probably a role for a conduit, and somebody that can do storytelling and can contextualize things. And so, honestly, I've been chancing it ever since then. Like I know probably 25% of what's going on in depth, and the rest of it is broad brushstrokes, because the space it doesn't get less complex, it gets more complex. And anybody that tells you that they're an expert in Web3 is a liar, because
I wholeheartedly agree. And I mean, that's a point I'm just going to pause on there and say it. I say it constantly. I will never call myself an OG. I will never call myself an expert. I simply insert myself in as many conversations and as many projects as I can, because there's always continued learning. And so from your perspective, I still, unfortunately, will call you an expert, but an expert from the fact that you know how to derive value out of the ecosystem and out of the asset class. Not that you can just snap your fingers and create a project out of thin air, but you understand the value propositions and the business structure of which gets missed by so many of these new startups in the Web3.
Yeah, I mean, look, so, the benefit of now being an accelerator, like that throughput of startup, both that we speak to, we perform due diligence on, and then we work with. So I think last year we probably spoke to about 2,500 startups. We did due diligence, like deep due diligence, on maybe a third of those. And you get basic pattern recognition from that. You don't need to be a genius, because they're pre-seed stage. they're very early. It gives you this kind of 3 to 6 month window on what's coming to the market, and you just need to synthesize that and then feed that back into the market through your kind of thesis. Then once you kind of start working with the startups, initially it'll be 200. There's some things that you can do in our program which are standardized content, right? These are certain things you need to know. And then there's a lot of custom work. But each time you do it once, a lot of it is transferable into another startup, another industry. And so, it's just exposure. Like, the more you're exposed to this stuff, for me personally, the more sense it makes. If we look at how we operate as Outlier, we're about we're going to be at 125 full-time staff.
Wow.
Probably half of those are specialists like token engineering, design, governance, regulatory compliance, issuance, technical analysts. We've got Dow experts. The other half are generalists that are looking at go-to-market strategy, fundraising, structuring. We have investment committees where we look at the projects that we're going to work with. I just got off one now. Half the call, I just sit back. I've got no value to add. We've got brilliant people who are going really deep, like the DeFi. Some of the DeFi stuff is just above my pay grade. I just sit back. I listen to what the experts are saying in our team, and I try to make sense of it. And then there'll be other things where you have a bias towards. So like the whole NFT and metaverse play, that's much more my space, right? So the trick is, acknowledging your weaknesses, and I've got many, and making sure you plug them with brilliant people, and then just creating a process that's scalable. And that's taken us 8 years. For the majority of our life cycle, we were at the mercy of the markets. It was either boom or bust. You mentioned 18. The end of 17 was brutal. We had to cut our staff by more than half. Some very great, brilliant senior people. We were back on to living month by month, quarter by quarter, because we didn't sell. We would take venture-like positions in everything that we do. So we had, positions worth a lot of money, and we generally didn't sell them down. And we were like, oh shit, should we sold those? Was that it? Was that the cycle? Is this whole thing over now? Is the ICO over? At that point, investment capital, VC capital totally dried up. And
yep.
we're at an inflection point. We're like, do we stick at this? It's going to be a grind, and it's going to be a grind for another several years. Do we have that much conviction? Or do we just kind of, get rid of all of our costs, maintain the assets we've got when the markets recover a bit? If they do, we can just sell those off. But honestly, I'm not going to say we were totally convicted. I think everybody had a wobble, right? You wouldn't be if you didn't wobble in 18.
Yeah.
Because it was brutal. I mean, it was 2 years, really, really. We were helping blockchain startups to pretend not to be blockchain startups to be able to raise money. Which is, as a blockchain accelerator, as you can imagine, quite challenging.
Yeah, no, it is, and so I want to touch on a couple of points that you just made right here. And really it goes about the fact that it's very hard in an asset class this early. And you're talking about tokenized projects, of which you, in most cases, will have immediate liquidity. But the value is not there yet. They're still a startup. There's still there's a lot of work to do. And some of these times where you see the value rise by, thousands, tens of thousands of a percent, that's amazing. That's great. But it hurts. It hurts the project when you have the big VCs and the big initial guys suck that liquidity back out. So, I really give you guys, a round of applause for wanting to do the right thing and stay in. How do you manage that today? Because, you've got 250 startups, right now, and you've been doing, about 200 a year for the last few years. What's your overall, how do you manage that amount of coins and across thousands of projects that you guys have?
Yeah, well, so firstly, coming back to the liquidity point, we actually don't have immediate liquidity by design. Okay. So our vesting mirrors the founder's vesting. And that's really important to us as a signal, because projects that go through the accelerator, we get up to 6% of total token supply, which can be a very material amount if you consider the foundation, depending on how it's structured, might have anything from 12 to 20. We are, if it were a cap table, we're pretty much like a co-founder in terms of our position. Now, we provide a lot of value for that. This year we're going to spend about 30 million sterling on overheads to service, to provide value, staff and everything else. But it's a material amount. And so for us, nobody's going to invest in that thing if they think we can dump. So we just remove that from everybody's head. It's like, look, we vet whatever you think is acceptable for the founders, we will mirror that. And so what that means is that we're vesting over up to 3 years. It might not start for 12 months. It could be linear, monthly, quarterly, and there might be a cliff in there. So we compared to equity, like Y Combinator equity, I mean, we're liquid way earlier. And actually the success rate, if you compare a Y Combinator startup floating and an Outlier project having a token launch, both public events, I think it's something like only 5% of our 135 startups have outright failed in 8 years.
Wow.
And 75% either have had a token or on track to have a token. We've only got 25 live at the moment, but we've got a backlog of 25 waiting to go as soon as the markets are recovered. So we'll double that. So we're not thinking about whether we sell or hold. Actually, it is removed from us. We have vesting, but then even when it's vesting in liquid, most of these projects don't have the level of liquidity where you would or could sell off into the market without damaging the price. Now, if you believe that thing has long-term value, the last thing you're going to do is ruin its ascent. Most of the projects, bar a handful, enter outside of the top 100. They've got a very long climb to become even a top 100 token. However, even being outside the top 100, we can be making, 7-8 digit returns. And if they go into the top 100, or even the top 50, we've had positions in one token where, well, what was it? It was like high 9 digits. So material awesome. Position. The thing is, and maybe we're stupid, right? We don't know yet. But we believe that the value of the franchise that we're building over the next decade is worth more than our reputation of exiting any one position, even if it could allow us to take a very material amount of money off the table. So from that perspective, we are high conviction. But also, if you believe that the asset class as a whole is going to grow, and you believe that your portfolio will outperform on average, then again, you would be a fool to take that money off the table. So we're very disciplined about it. We're very convicted, but the most important thing for us is our signal, right? Yep. That's worth several billion. And so there's nothing else. There's no deal. There's no transaction I can do that is worth devaluing that.
I love hearing that. Because, listen, I talked to a number of VCs and you're not really a VC, but they're kind of in the asset class just to, for the pump and dumps and everything else. And so, you're providing real value. When I say real value, there's tons of money. Even today in a market of which it looks like a barren wasteland, there's tons of VC and institutional money just right now prodding and poking, looking around for where they're going to deploy. And it's again, no one's looking into a lot of these other asset classes out there in the TradFi world. But DeFi, I think, has proven itself to hold up. And while the Terra's gone, there's still a lot of innovation on the Ethereum ecosystem, and as well as a number of others that are out there that are proving to have long term sustainability and value. So I want to kind of pivot a little bit on some questions I asked you the last time we chatted, and that has to do with the overall, like, some of the most common mistakes that you guys see by the time they get to you. And specifically one of the ones that I see quite often, which is like, you have this amazing team, an amazing concept, and their primary focus is how to give away control. This rush for decentralization. What's your experience with that, and just anything around that concept?
Yeah, so I had 2 calls today with 2 startups in our live in 2 different programs. We're now running 4 programs of 8 to 10 in parallel, and had 2 today with projects whose primary proposition is around being a DAO of sorts, supplying it to different industries. And the thing I always say is DAOs are conceptually great. I think actually at a kind of slightly esoteric level, they reconcile the free market fundamentalism of crypto and the collectivism that comes through smart contracts and DAOs. And it kind of reconciles the sovereignty of the individual, free markets, and collectivism, and allows for that to be seamless and fluid. I mean, that's just mind-bending when you think it will happen at scale. And it will happen at scale at some point, because there's just too much of an economic incentive for it to not, right? And there's too many brilliant brains working on it. However, the reality is today, DAO tooling is very basic, very elementary. And also, as you say, there's this kind of dogmatic concept still that projects need to be sufficiently decentralized or community governed and driven. And the reality is, you've got to remember, certainly the stage that we're dealing with projects, most of them are still early stage startups. Yep. And startups are experiments. And, we've got a couple of decades now of lean startup thinking, where you're iterating, you're experimenting, you're validating assumptions, and you need to do that with as little friction as possible. And ultimately that means centralization. It means a handful of people, maybe not even that, 1 or 2 people calling all the shots. Creating that feedback loop, iterating until you have product market fit. Then once you've got product market fit, it makes sense as a means to engage community, to bring them into the process of making decisions. However, I reckon the majority of DAOs aren't what most people think are DAOs, right? So how most DAOs function today is not really as DAOs at all. They are off-chain decisions ratified on-chain. So really, most DAOs are Discord servers, and private messages in Discord servers by a small group of people, and then they'll ratify that on-chain and have maybe some voting, which is more kind of for the vanity voting than anything else. And engagement's really low because people have got better things to do than to vote on every minor decision. And I think there'll be a certain threshold to DAO governance anyway. And before you need delegation, right? You have to delegate vote.
It's a very new concept. And you're right. The technology is not there. I mean, there's no public company or a private company that exists that's going to be asking their employees or their user base, what color should the website be? I think I'd like to order lunch. Would everyone like to put this out to vote? And I see some of these votes on certain protocols, Aave and everything else. And I'm just like, this is not, some of these should not be up to the community. Like, some of this is, there's no way, I don't care how many shares these people have, that they have all the information to properly decide, is it A or B? There's a lot of research, that needs to be done, and long-term vision that kind of gets lost on there. So, how the rush to distribute these tokens, the rush to go on chain, you and I have talked about in the past. It's a little bit of the own founders FOMO. Like, oh my God, I got to get this out there. And if I'm not out there, then I'm not a real project. How do you kind of quell them and get them to slow down and focus on the business?
Well, actually, I think that the sad reality is the reason why there's this rush to decentralization is it's a perverse um, byproduct of US regulation,
Hmm.
right? So because a lot of innovation operates in this gray space of it, is it a security or isn't it security? There is a regulatory pressure to add more risk to the system by decentralizing it. And so, as you mentioned, like, what is the threshold for certain decisions? Have you thought through the game theoretics of how different stakeholders will behave if they're acting in their own self-interests? What kind of governance attacks are possible in that context? That's very, very complex. And so, you certainly need to be a mature enough network and a mature enough proposition before you could even consider opening that up, let alone then being able to second guess how these things are going to play out. So I think you can blame the SEC for this almost squarely.
We can blame them for lots of things. They don't listen to me at all.
No, right. And they kind of pushed innovation to the point whereby they're decentralizing to a degree and to a velocity that it doesn't actually make sense, and adds more risk to the investors that are backing these projects and to the system as a whole. So that's why it happens. But then, how do you talk down a founder? I think, and it's an overused term, but this kind of pathway to decentralization, it's thinking through, as a startup, how are you going to roll it out? What do you go to market? What's your go-to-market strategy? What are the things that what are the things you still need to validate? And then making sure that they're kind of methodically working through those. A big part of what we do is, well, remove the complexity of trying to make these decisions, because, like I said, I've got 125 people. This is all we do all day long. Try and be two founders with an MVP trying to solve all these problems. You can't. It's impossible.
Yep.
It costs me, 27, 28 million a year, maybe $35 million a year to solve this problem at scale. So, like, good luck with that. So, the great thing about people that join the accelerator is they generally have humility, because they're there because they understand there's things they don't know, there's connections they don't have. And so they come into it in the right mindset. To be honest with you, as a founder, I would have never gone into an accelerator, to my great detriment, because I'm learning on my own book, right? All the mistakes are at my expense. So I've got huge admiration for the founders that join our accelerator. And then where they're there, it's about removing, they're overwhelmed by all these decisions. They are compelled by, false narratives. And it's about stripping things down, simplifying it, and putting a kind of a rigorous structure behind it. And, the reality is, once you've done your basic go-to-market and fundraising, we've got a part to our business called Ascent. We've got Basecamp and Ascent. We use this mountaineering analogy. Ascent works with both projects that's gone through our core accelerator, but also third-party projects that have raised loads of money. They've got loads of people. They've got the beginnings of a community, and now they need to launch and sustain a token economy. And that we've got down to an art. It's actually a list of pretty much 95 things you got to do in a particular sequence. And you can skip some, but it's going to come back and bite you in the ass. It's going to take longer. You're going to have after effects in secondary market and various things. So some things you can systemize, right? There's no nuance. And then other things, more at the design phase, it's about removing the complexity that overwhelms a Web3 founder, because it is 100x more complicated to be a Web3 founder than a normal founder. And that's hard enough, right?
Yeah. I mean, and it literally has to do a lot with the development cycles of things. In a Web2 thing, you can put out your website and somebody complains about it, or there's something wrong. Okay, I got to fix this. We'll kind of keep bringing the car back into the shop. But with Web3, you're launching a satellite. And once it's up in space and it's out there, like, enjoy, because you're not going to get another chance to do that one again.
Yeah, I mean, again, the great thing we're working with founders, which is what I get to do all day long, is they're optimists. Like honestly, I can't imagine what else. I'm so happy I happened upon this. Like I didn't know this was a thing. I never dreamt of doing it. I'm not qualified to do it. It just happened to happen.
I think you're the only. I think you're the only one qualified to do it. Is the reality,
Well,
Jamie?
I appreciate that, but it doesn't feel like it, right? And but you're working with these founders, and you're working through cycles. So the big one now, of course, is, well, is it a bear market? Are we in a winter? Is it going to become a winter? And coming back to what you were saying at the top end, we've got so many data points at Outlier, right? So we're being pitched daily by tens of startups. We're syndicating investment opportunities at pre-seed, seed stage, and then even later stage A and B, or kind of closer to listing. And we're doing that in volume. And so I wish we had a better analytics, to be honest with you, but it's a little bit kind of feeling your way. But I can tell you, last year when we had, I think it was August, there was this correction, about 70%. After things rallying, all-time highs, everyone thought they were rich again. And then it's like 70% haircut, like dramatic over a month period. And everyone was like, oh shit, are we here again? Is this going to be the slow decline? Now, hadn't I been having all the conversations I'm having, more and more founders coming in, some of the best Web 2, really amazing Web 2 talent from big tech, hemorrhaging from big tech, pouring into Web 3, investment rounds closing in a matter of days at still ridiculously large valuations, and a new fund being launched every week, even though the markets were down 70%. I was like, this has never happened before. Like, this is different. There's high conviction from enough money. There's actually, I would say, overcapitalization in the market right now. There's more money than there are good startups. We've never been in that position. Maybe 17, but like, and that was retail dependent. This is like proper institutional money. It's in a fund. They have to deploy it. They don't get the carry and the management fee. And so, the retail market's still all over the place, largely driven by the macro environment, because I think crypto is now big enough that the people that hold crypto, their sentiment's driven not by crypto, but by whatever else is going on in the world, right? And
absolutely,
the majority of their wealth or their holdings. And so, the kind of retail market just sloshes around and actually amplifies the volatility of what's going on in the wider world. But as you say, tech stocks down an equivalent amount of money. But the difference is there is this wall of money that's coming from the venture side into crypto every day. And interestingly, what we're now seeing with the massive correction in Web 2 and big tech is there's a huge amount of talent that has been following and even investing into crypto and Web 3 for several years, but have never really been able to leave the comfort of big tech, the share options that always seem to just go up, the comfort of a job. Well, guess what? The share options look a lot less attractive now. Their future looks a lot less certain. A lot of the massive layoffs, whether it's Uber, saying they have to be profitable, whether it's Klarna in Europe, they just got rid of 70% of their staff in 1 week. Guess where most of these people are going to go? They're either going to set up a Web3 startup, or they're joining them. We've got a jobs board for our portfolio at the moment, 95 Web3 startups recruiting. I think it's 275 jobs.
Wow.
So something is different. This is not 18, right?
Yeah, and I'd like to echo a number of the things you just say, and clearly it is, you are I know you hate the word expert, but you're the one that sees the playing field, and so from your perspective at that 80,000 foot view, you see things that everyone else can't, even if they're standing right next to it, they don't see it because they can't see all the pieces, and so I always enjoy talking with you about this because hearing the way that you're seeing the playing field kind of reorganize itself and prep for the next wave, and there will be next wave. When will be that's up to the higher powers, the big guys that control the billions and billions of funds to manage. But I want to hit on one last point, as we kind of wrap up our conversation here, and that's to me the most important part of Web3 that consistently founders miss, which is community. And I get pitched way less than you, but I get a number of pitches and a number of projects that are struggling. They come and say, how can you help, whatever the case is. And the first question I ask, I don't care if it's a DeFi project, an NFT project, or whatever the case is tell me about your community. And then you get the blank stares. Well, we're building one. We have some people on Twitter, and we have a Discord server that's coming online soon. What's when you have those conversations with your people, what's the where's community fit into kind of that 95 checkpoint list that you have?
Yeah, I mean, no, you're absolutely right to pinpoint this. So we really, well, actually, I'll step back a bit. The problem with being a founder in this space is you've got a small team. Maybe you don't have a team at all. It's like you and a co-founder. You don't actually have any employees. You've got some contractors or whatever. And you're either very technical, and so you're focusing on the technology a bit too much, solving technical problems that you don't even know whether anybody has or would pay for. Or they're very commercial, so they're focused on the market, right? This is our kind of go-to-market strategy. And this is especially true with people coming into Web3 from Web2, is they've connected the dots that Web3 technology can enable this new market opportunity or this new product or offering this optimization, this efficiency gain. But because they're not of the community, they don't understand it. They don't understand it's got its own language. They don't understand it's driven by memes. They don't understand that nobody gives a shit about their technology and even their CV without that kind of momentum within the community. And this is because I think most projects don't appreciate that they are becoming a public company, right? The minute you have fungible token, but also non-fungible tokens now, right? You are a public company. You are part owned, or if not majority owned, by the community. Yep. And these people are generally not professionals. They're not professional investors. They get angry. They're very emotional. They have short attention spans. And generally you operate in this like FOMO vacuum. And so most projects kind of focus on, understandably, well, like we've got to build a product, we've got to build a tech. And they won't even hire like a community manager or even a CMO until, like for us, we really push on this as early as possible in the program, but it doesn't matter how many times you say it, people will leave it till the last minute. Oh, now we want to launch a token. Okay, well, nobody cares. Like you don't have a tribe. You don't have that momentum. You don't have that demand. You've not built up that demand in the market to launch that token. You've not communicated why that token is going to have value, why it's going to have utility. And so they're often playing catch up. And so we insist on it in the core accelerator, and then Ascent. A big part of Ascent is about building momentum around that token launch, but then also making sure it's sustained in the secondary market as well. So it's not something that's like a one-off, you IPO and there you go. You then need to create a whole communications infrastructure to be able to constantly communicate with that community. And it's a real overhead. To founders, it's a real overhead. There's a reason why a lot of private companies have never gone public on the stock market. It's a pain in the ass. Forget the reporting. Just like it creates short-termism. It's very distracting.
Yeah, again, there's so much here, and Jamie, we could talk for hours about it, and I'm going to continue having you on. Normally, I ask for people to say, where's the alpha drop? Give me a couple cool projects, but I can't do that with you because they're all your children and you love them all. So instead, kind of give me the 1 or 2 points on that 95-point checklist that really anyone that's even thinking about doing a Web3 startup just should start off in their head with before they make those first steps into going into the space.
Yeah, I think you've got to become part of the community, right? So I'll give you a great example. 50% of the founders that join our accelerator don't have a Telegram. They don't have a Twitter account. Don't have a Twitter account. I'm like, you're dead. You don't exist. As far as crypto is concerned, you do not exist. You're not a human. And they're like, oh, do I really have to mess around with Twitter? And I'm like, if it's good enough for Elon Musk, the richest man on the planet, the most successful founder on the planet, it's good enough for you. Get a Twitter account. Here's some people to follow. You don't have to worry about tweeting. Just start following. Get plugged into the meta brain, right?
Okay.
And
I feel personally attacked by that one.
Well, you should do, right?
I absolutely should.
And you don't need a big following, but this is like an environment where your newsfeed is curated by some of the biggest brains on the planet. It's a really lazy way of knowing what's going on, but it acts as a barometer. It gives you, you notice how many people I follow. People always think, oh, did you buy my followers? Did I have follow people so they followed me? This was a growth hack a long time ago. You'd follow people, they'd follow you back, and then you'd unfollow them, and you'd end up with more followers than you were following, and it looked like you were influential. And so I think I follow 15,000 people, something like that. And everyone's like, but why? Influential people only follow 50 people and they've got hundreds of thousands of followers. I can't, if I find somebody on Twitter who's talking about something I don't know, I will instantly follow them. That's just one other node in the mega brain that I'm assembling. So the more people you follow and you're following the right people, it gives you a barometer on the market. It allows you to tap into the memes that are driving narrative. And the biggest challenge for startups is timing. We've had some startups that have exactly the right proposition. They were too early. Nobody understood what the hell they were talking about. Boson Protocol is a great example. So in crypto winter, they were talking about e-commerce and how NFTs would be used for a new kind of form of e-commerce and digital to physical redemption. Everyone was like, what the hell are you talking about? Because it's pre the metaverse narrative. Yeah. Now it's the narrative, or certainly in 21, it was the narrative. So understanding the memes that are driving attention in crypto, capital follows attention. So you need to know the memes that are driving attention. If you, as a founder, if you can tap into the zeitgeist, into the memes, often it's just how you can textualize your offering. So these are relatively soft things, but once you get a founder to start doing them, it kind of becomes transformational. And then the final byproduct of that is they start speaking in the language of Web3. And Web3 smells it a mile off, right? Yep. Somebody's new, they're trying to blockchain or crypto wash or metaverse wash their startup, but the language is a little bit off.
It's like that Hello Kids meme, you're like, hey, fellow kids, hi, I'm a... Right. No, it entirely, Jamie, you're correct. I'm a terrible Twitter user. I don't use it and I don't like it, and that's fine. But it was interesting because I was at Permissionless. I met not one, not two, but three chief hype officers. And I had no idea that was a thing, but it's clearly a growing segment of that's all that they do is tweet and make, kind of the hype in place of the founders like myself who are old curmudgeons.
Well, look, I think I've actually found a sweet spot because I'm also, I wouldn't say I'm old, but I'm not young, right? I'm 41. In crypto terms, I guess I'm like,
Yeah,
relative.
we're ancient, man. I'm just 1 or 2 years older than you.
So I bridge LinkedIn and Twitter, and they're totally different. Like crypto LinkedIn is totally different to crypto Twitter.
Yep.
Generally, people who do crypto Twitter don't do crypto LinkedIn, and vice versa. There's an aversion to one another. I actually really enjoy getting both of those perspectives. Very different narratives, very different communities. But look, I'm also too old, don't have enough time to do. I've stopped doing any Discords. I've stopped doing any Telegram. Like that's almost like suicide in Web3.
Yeah.
But it's too overwhelming. Like,
it's clear that, and I have the same issue. I run a community and it's the same thing. I'm overloaded with like, oh, hey, here, are you on WhatsApp? Are you on Telegram? Are you on Signal? Are you on, and I'm just like, I do email. I do Discord, and I do LinkedIn, and those are and I barely can keep up with those. So right. I really do appreciate the thought around there for people you have to be engaged and understand your memes. Reddit is a great source of those, but it's a source of lots of other disinformation as well. So it's clearly one of those things. Jamie, I very much appreciate your time. Remember, don't run anywhere yet. But I want to thank yWhales again, and Jamie, really, for anyone that's interested in applying to Outliers or just wanting to know more about Outliers, what's the best vertical to go find you at?
Yeah, so I mean, there's lots of content out there over the last 8 years. We probably produced too much content, but like, you go to our website, outlierventures.io. You can see we've got a research section there. You can see a lot of our thinking, frameworks for token design, blah, blah, blah. But what I would recommend is if you just want to straight up apply, you go to outlierventures.io/basecamp. You'll see that we're always recruiting because we're now running parallel programs. We run a lot of programs with for particular protocol ecosystems. So we run a Polygon one, we run a Polkadot one, we run a Hedera Hashgraph one, Filecoin IPFS, and we're launching several more. So that's working with those ecosystems, their foundations, their partners for startups, the best projects building in their ecosystems. And then we also have an agnostic one where we don't care what you're building on. It's just about the team and the market opportunity. And we're always recruiting. So the reality is the standard is very high now. I think we accept into accelerators sub 5% of applicants. But what I would say is if you apply now, you'll get some feedback from the team. We can't like give detailed DD back to everybody, but everybody that applies, you'll speak to one or two analysts, and even if you don't get past that first stage, they'll feed back to you what they're seeing. And honestly, these people know more about the market than me because they're the ones filtering the startups before I even see them. So they've got even deeper understanding what's going on. And the worst they're going to say is, well, you need to work on this. You need to find this person. You need to add this person to your team. Or actually, that's a very competitive landscape. Have you thought about X? And, the worst we'll do is say, come back and apply again in a quarter. And we've had some startups apply multiple times before they've got in. Crucible applied 2 or 3 times before they got in. We've had several do that. But we've always kept this dialogue with them, and we've watched how they've progressed and helped them out.
And that's why you're so valuable, is because you guys do see so much, and sometimes no is the correct answer. It may be hard to hear as a founder, but it can be, and go back and come back again. So I love those answers. I love everything you guys are doing. Thank you for everything you've done to help in Web3 and truly create a lot of what the VC space is today. Because I mean, you just having the longevity to go through the multiple crypto winters and 8 years in the industry, like you built this. So again, Jamie, thank you so much. Hang out here for a second. Don't run away. yWhales, we'll catch you guys next time.